Hey guys, it's Ryan G. Wright with DoHardMoney.com coming to you with a Just Ask Ryan question of the day. And today's question is how to present a real estate investment. This is going to be working with a partner or trying to find somebody to help fund a deal or gap finance and those things. But before I do, I thought it'd be kind of fun for me to show you our studio that we have in our office. So I was going to show you our DHM studio. This is the studio where I do my podcast from with Income Hacker. If you're not a listener, it's where I do my live cast from and where we do any filming. So, you know, it looks kind of cool. When I'm sitting here, everything looks perfect, right? Like it's got everything just aligned perfectly. But when you look at like everything that we've got in here, the place is actually kind of a mess. There's wires everywhere, there's stuff everywhere, there's cameras and lights and I don't know, more cameras. There's a camera there, there's a camera there, there's a camera there, there's a camera there. Lights turned off, lights turned on, different screen. If you're not joining us for our live cast, they are every Tuesday at 6 p.m. Eastern Standard Time. We even have a huge microphone there. Anyway, I thought it'd be fun to come in here and talk about this subject matter. So the idea is how to present real estate investments. Before I do though, if you would like to have me answer a question of the day, every single day I put out an answer to a question or a specific topic. These videos are 3 to 7 minutes depending upon the topic matter. I'd be happy to answer it. All you've got to do is write your question in the comments below and I'll create a video just like this for you. So how to present your real estate investment. So here's what I'm going to assume here. I'm going to assume you're trying to present this to a business partner or you're trying to find somebody to do gap financing. So typically what will happen is you may find an opportunity that's a good deal, but it's not a great deal. And so a hard money lender, most hard money lenders won't give you the money for the rehab and for the purchase. We actually will do that. However, it's got to be a good deal, like a really good deal. If it's just an okay deal, maybe a base hit, you're not going to be able to get that. You're going to have to come up with some additional funding. So there's multiple ways to come up with additional funding. But one of those ways is to find a business partner or a gap financer. And this is where I'm presenting this investment opportunity to somebody else. What I've got to do is I've got to make a list of everybody I know that actually has the money to do this. And this may be $20,000 or $30,000. This is the difference between what the hard money lender is able to do and what you need. So for example, let's say that you're buying the property for $100,000 and it needs $20,000 worth of rehab. And let's say there's $10,000 of closing costs. So you're at $130,000. And this is just for number's sake. And let's say the hard money lender is able to do $120,000. So you're $10,000 shy of making that happen. Now, of course, you can go and try and find the money yourself, but let's say you're $10,000 shy, or even say you're $20,000 shy. What you need to do is make a list of everyone you know that has $20,000. And then you want to sort them in most likely to least likely to give you the money. And then you want to start with the most likely, and you want to call them and say, hey, I have a great opportunity. I have a real estate investment that I'm doing. I'm about $20,000 shy of making it happen. I've got a lender willing to give me the money. I have found the property. I've got the general contractor, and I need $20,000 more. And I was wondering if you would have interest in getting your money out of that crappy CD or out of that bank account that's doing nothing and actually get it working for you. I'm interested in doing a joint venture or a loan. Depending upon what you'd like, we can do a profit split on the profits, or I can guarantee you a certain interest rate, but I'd like to pay that interest rate when I close and pay off the property. And so you can send them all the details. If you've already gotten a loan like from us, you can send them the values that we already have done, the third-party values that have already been done on the property, so you can say there's opportunity here. What you're trying to do is make your case, and the best way to do that is with evidence. So the evidence that I'm going to show is the values. Here's the values that are done independently. Here's the construction bid that was done independently. Here's a breakdown of the numbers if it sells for what these two valuators say. And these are the costs associated with, and this is the construction bid, and I typically like to have 2 of those. This is the profit margin. Let's say there's a $30,000 profit after we pay you back your $20,000. I'd be willing to give you 8% interest, 12% interest. I would be willing to give you 20% of the profits, or whatever that number is. You kind of decide, and then you can let them make the choice. So basically, the idea here is debt versus equity. Okay, debt means you are promising to pay them back that $20,000 at a certain interest rate. Let's just say it's 10% interest rate, which means that $20,000 at 10% interest, if it goes for an entire year, you would owe them an additional $2,000. If it goes for 6 months, you'd owe them an additional $1,000. Now, that is more risk to you because you're liable for the money if things go wrong. However, you're paying a lot less, so that's the pro side of that. The other way to do it is a joint venture where you say, put up the $20,000, you'll get the first $20,000 back, and whatever's left, I'll give you 20% or 30% of it, and I'll keep 70%, or I'll give you 40% of it, or I'll give you 50% of it. Now with that, they would be making more, maybe $10,000, maybe $15,000, maybe $5,000, which is a lot more than the $2,000 they were willing to make. However, if there is losses, you're not responsible. You're not liable for those. Now, obviously, they're not going to be excited. It might hurt a relationship, but they're taking on that risk, and that's one of the things you've got to be very upfront with them and say, hey, if we do a joint venture, you're taking on the risk. If things go bad and you don't get paid, I don't want that to hurt our relationship because I'm going to tell you everything, and you're making this choice. And so that's what you've got to do. So debt is you're liable for it. Equity means they get what they get, and that may be good or that may be bad. And the reason they do that is there's the opportunity to make more money. But you've got to be very upfront with that there is risk. And that's one of the things I think people do a really bad job with real estate investments. Finding a partner, finding a business partner, a gap financer is not explaining the risks to that. But I want to explain the risks, but I want to have evidence that shows that it probably is a very low probability that it doesn't go the way that I'm thinking. So this is going to go the way you're thinking, and let me tell you why. Here's the values that are independent. Here's the construction bids that are independent. Here's the breakdown. So it would have to be something kind of crazy, like we find something crazy wrong with a house we didn't know about that costs more money, or a market has a total collapse. It's going to have to be an outlier, not something. So the probability is it's a low probability something like that would happen, but here's the risks and here's what's associated. So if I'm talking to that investor, I'm saying, hey, if you want to, I'm willing to be responsible for that $20,000, but it's going to be an interest rate, a low interest rate. However, if you want to risk your money and take on some of the risk, which is higher risk, higher reward, I'll give you a percentage of the profits, but you've got to realize you're taking on the risk. I'm not liable for that money. If something does go wrong, I'm not liable. Now, I'm going to work my guts out, and I'm the last person to get paid. This is what I'm saying to the investor. I'm the last person to get paid. You're the first person to get paid after all the agents and after the contractors and everything else. You get paid first, and then we do our split with anything after that. So again, make a list of everybody you know that has the money. Show them evidence as to why it's going to be good deal. Explain the risk associated with that. Talk to them about the difference between them lending money and doing a joint venture or being an equity partner, and then ask them if they'd be interested. And then basically the question really comes down to, what would you be willing to do it for? At what interest rate would you be willing to do this? At what percentage split would you be willing to do this? And lots of times they'll say yes. Lots of times they'll say no. And then you go to the next person and say, here's an opportunity, take a look at this, this is what we could do. Now, I will say this, most of the time, the person giving you this money is somebody that loves you. So you've got to make sure you're really careful and really cautious, because you do not want to strain relationships. You do not want to have family feuds over this. And sometimes that can happen. And so making sure everybody's upfront and understands the risk associated with that, the rewards associated with that, and having something in writing that shows how that relationship is made is really important. Now, if you're doing that, if you're one of our members and you have gotten a business partner, let us know, because our attorney can write some of that in or get some of those things in writing or help you out with that. If you're one of our members, that's typically not a big deal, but something you should know. So I hope this has been very helpful for you. If so, please hit the thumbs up button. It tells YouTube logarithms that they should promote this content, and it's super fun. It really helps us out, so I'd appreciate it. I've got a couple other things. I've got a free resource for you. It's our property value analysis. You can download this. This is exactly what you would want to give this investment partner to show them the breakdown of all the costs. It's super professional, and it shows that you have thought through everything. You can have it absolutely for free. All you've got to do is text your email address to this number, so you don't have to put it, please send this to me or any of that stuff. Just send your email address. That's it, and then the system will automatically send it to you. The phone number is 435-294-0433.